technology. The meeting is being recorded. Yes, I'm willing to be recorded.
Right, we're waiting just a little longer until
That's absolutely fine. I'll have another sip. Make sure I can have sips while I talk. It's always useful for me. Ayan, can you hear me?
Yes, I can. I had muted myself, so yes, I can hear you.
Perfect, and I can hear you just great. So
the chat,
good.
Andreas, would come up somewhere here, right? When people type in questions.
There's a Q&A chat. You will be able to see it.
Sure.
All right. So the attendee count is no longer increasing quickly. So it's time to start the seminar. Welcome everybody to the latest edition of our webinar on microstructure. I'm Andreas Park, and I'm very happy to have Gideon Saar here to talk about his work with Ayan Bhattacharya on limit order market under asymmetric information. Before we start the webinar, there's a few housekeeping items and a few announcements to make. The first is next week's speaker will be Chester Spatt. Then we have had, many of you, or at least the junior people among you, will probably be waiting for us to announce the presentations that we're inviting for the month of July in the Emerging Scholars Month. We will be making that announcement within the next 2-3 days. We want to also thank all the reviewers who have participated in expressing their views about the respective papers. We really appreciate the help that you give us for this seminar series. Then once we have made, once we went through the month, there is a decision to be made what is going to happen in August. We will take a small break in August at around the SAFE and EFA conferences, simply because we don't want to clash with them. And it seems to be also a time when people want to maybe take a break from research. And then thereafter, for the fall, we want to have, again, an open submission for papers. So in contrast to the first seminars, where we invited people, we will have another call. We have not put the call out. We'll do that also within the next few days, and the deadline for that will be June 30th. Other than that, I think we're now ready to start our webinar. Again, I'm very glad to have Gideon Saar here present to us his work. And Gideon, the floor is yours.
Thank you, Andreas, and I wanted to thank all the organizers of the Microstructure Exchange for inviting me. This is joint work with Ayan Bhattacharya, and Ayan is with us, and he's going to be monitoring the chat and answering questions that you may have. And also, whenever I will be answering questions, Ayan will unmute himself and join me whenever he wants to. All right, so limit order market under asymmetric information. Why is that interesting at all? The adverse selection paradigm has literally transformed market microstructure with the two very popular frameworks, the Glosson-Milgram-Isley-O'Hara framework, which I also call traditional sequential trade models, and Kyle 85. And those are dealer models. And over the past, that was kind of in the 80s, and over the past 20 years, exchanges around the world have moved to predominantly being electronic limit order books. So you would think that researchers would also shift to working with limit order book models, but this hasn't happened. So the question is why? And Christine and Dwayne in their limit order survey have this thing that they say that limit order is a pretty simple construct, but limit order book models are very complicated beasts, right? You've got very large state spaces, action spaces, very complex dynamics. And so, I know of 3 models basically that try to incorporate full-fledged dynamic limit order book with adverse selection, and all of them at some point had to resort to numerical solutions. So what Ayan and I wanted to do is create the simplest possible model we could of a limit order book, dynamic limit order book with asymmetric information that would lend itself to an analytic solution. So what we did is we took the simple trader arrival and information asymmetry environment of the Glosson-Milgram-Isley-O'Hara framework. but replace the dealer structure with the dynamic limit order model of Leonid Rosu from 2009. And that hopefully, I'll show you, will give us some interesting insights. And beyond that, that will give other researchers, hopefully, a simple model of limit order book with adverse selection that they could use to extend and learn about a lot of other things. So that's the motivation. And this is going to be very brief literature survey. I'm sorry if your favorite paper is not up here. Of course, there is Larry Glossen's famous inevitable limit order book paper, but this is a static framework. Although Baruch and Baruch showed that kind of the upper tail conditional expectation is somewhat more general. But the dynamic limit order book models, from my perspective, started with the work of Christine and Thierry in the late 90s. And I learned a lot from this set of models that I put up here. But when it comes to incorporating adverse selection, it was very difficult. So there's a couple of hybrid models basically used dealer pricing to kind of bypass this problem. But the three models that actually tried to do that, and here I listed them, Gettler, Perron, and Rojan, and Ricorindi, and Seppi, and Rosu, again, all resorted to numerical solutions, and that's where we come in. So let me give you the setup of the model, right? The market is organized as continuous time limit order book. Trader can, submit limit orders and market orders. All orders are for 1 unit, usual priority rules, continuous price grid, pre and post trade transparency. Orders are anonymous, very much like the traditional sequential trade models in that. Also like those models, we've got an asset whose value can be either high or low, right? V plus sigma, minus sigma, Bernoulli distributed with Q0 as the parameter. And nature chooses the realization of the asset before trading begins, but not everybody knows that. And that's where we move to talk about the traders. So we've got uninformed traders with exogenous trading needs, like in traditional sequential trade models, either buying or selling for hedging or liquidity needs. But we also differentiate them along with their immediacy needs. So following the literature, we have patient and inpatient traders. The inpatient traders, buyers are BI, buying inpatient, sellers SI, simply use market orders to buy and sell the securities. And that's very much like the uninformed traders in traditional sequential trade models. We give the buyers outside options just above V plus sigma and the sellers just below V minus sigma for a couple of reasons. First of all, we don't want to have unbounded losses, and also it basically limits the trading to V plus sigma to V minus sigma, very much like the traditional sequential trade models. We've got 3 types of patient traders, and that's kind of what's interesting in our model, right? The patient traders. 2 are the uninformed patient buyers, BP, and sellers, SP. And you can see here, I'm going to sometime use this laser pointer at things, the utility functions, which will have the usual form, right? The expected value of the assets for the buyer minus the price they're going to pay, pi cap t, minus their weighting cost. And we can simply set R equal to 1. And we gave the patient uninformed traders also outside options. So buyers have outside options at prices just above VT, the expected value of the asset, sellers just below VT. And we did that for 2 reasons. So the first reason is that this basically gives economic content to what we mean by patience, right? So these traders would not be willing to trade or wait in the book if they expect loss. But again, it's not that we think that they can get the asset somewhere else at VT. You can think about it as a way to basically specify some sort of a preference that, a buyer at a price above VT is no longer interested in buying the asset. So that's the first reason. The second reason, it will allow us to simplify the model a little bit in that our patient uninformed traders will only submit limit orders. Now, in principle, there's nothing that I think cannot be done in this model by letting the patient uninformed traders choose between market and limit orders, but there's a lot of things going on, and we just wanted to simplify it a little bit. So they only submit limit orders with this assumption in order for us to focus on the choices of the informed traders. And so this is where we're going, because that's the 3rd type of patient trader. Those are informed traders. They don't have any exogenous need to trade or private value. Like in sequential trade, in traditional sequential trade models, they know the realization of the variable V, and they trade to exploit their information. And so their expected utility here, it's simply they know the realization of E and they can choose between buy and sell. And so their choices are, right, they have lots of choices to make. They can choose between buying and selling, submitting market or limit orders, and if they want to submit limit orders, also the limit order price. So with U, we kind of denote all the utilities of all the traders and the outside options. I want to stress, though, that this is a model for trading a risky asset. So if for some reason all uncertainty were to be resolved, and now all traders know for sure that the value says V minus sigma, then we assume that uninformed traders are only willing to trade at V minus sigma. And we're doing it to simplify. You don't strictly need to make that assumption. You will see later on, it will help us kind of show that the informed traders would want to hide among the uninformed. Traders arrive according to independent Poisson processes with constant intensities lambda. So now let's talk about the equilibrium concept. If you take out the informed traders from this model, it's simply Ioannidis-Rosu's 2009 paper. And so we're going to also follow the equilibrium framework that he did, which was Markov perfect equilibrium. And so the way we're going to structure the equilibrium, we're going to be talking about two games: the limit order market game at time t, GT, and a broader infinite horizon game, G, going from 0 to infinity. And I'll explain in a second. I wanted to first give you some notation. And, you know, this is not going to be one of those papers where I give you a set of assumptions and then talk about the result over like two very beautiful pictures. Sorry. The main innovation in the paper is this recursive procedure that we will show you of how to compute the wait times. And in order to do that, I need to introduce notation. So X will be the limit sell orders, Y the limit buy orders, XT1 will be the first limit order, which is the highest possible one, XT2, the one below it, and so on. And the limit order market GT game is basically defined in terms of the arrival rate, lambdas, the expected value of the asset, VT, XT and YT are basically the traders submitting limit orders, and PI and PK are the prices of the limit orders, and of course the preferences of the traders. So the players in this game are the patient, uninformed, and informed traders who are present in the market time T. Okay, traders who haven't arrived in the market yet, or traders who already executed, are no longer players in the game GT. And we don't even specify exactly the impatient traders here because they don't have any decision to make. That's basically part of the description of the game with the arrival rate lambda. The action of the players, patient, uninformed, and informed traders, choose to submit limit orders, and they choose those prices. And patient and informed traders could also choose to instead take their outside option, and informed traders could also choose to instead use a market order. So now let's do the definition of equilibrium in the games GT and G. The way we define equilibrium is iterated elimination of dominated strategies, which when you take out the informed trader is basically like what Ioannidis-Rosu is doing. So an equilibrium in the limit order market game time T GT is a set of limit order prices, buyers and selling. Informed trader choices of order direction, order type. Uninformed trader choosing between submitting orders and their upside options, such that, given common knowledge of rationality, no patient uninformed trader has incentive to reprice his limit order. No patient informed trader has incentive to reprice her limit orders, and the traders, choose between their outside option and the limit orders or market orders and limit orders. So this is the equilibrium in the game GT, and Ioannidis in his 2009 paper actually described very nicely how the kind of logic behind a cancel and resubmit idea. So when a trader arrives in the book and puts a certain price, another trader, if that's not an equilibrium price, could respond by repricing his order. Another trader will then reprice her order. And under common knowledge of rationality, traders should be able to reason this chain of event in advance, and of course then would submit in equilibrium the prices such that nobody has incentive to reprice the orders. And what we're doing then is we embed this iterated reasoning in a Bayesian rational framework, very much like this traditional sequential trade model. So the equilibrium in the infinite horizon game G is the sequence GT such that basically the expected value of the asset, right? I mean, traders arrive, informed and uninformed traders arrive, and the expected value of the asset from the point of view of the uninformed traders is updated given this sort of law using the Bayesian update process, and traders can cancel and resubmit their orders in accordance with the Bayesian update. Okay, so this is basically our setup of the model and equilibrium. And I think that it's a good time to take some questions before I move on to talk about how we solve this.
So at the moment in the Q&A, there are no open questions. So then maybe, since I'm the moderator, I'm just going to, abuse my power and ask a little bit of that. I'm sure you're going to go into some more details, but so this is potentially, I mean, this is a, it's obviously a very complex model, and there's a very complex process because, first you have this time is basically passing continuously. And as I understand it, as time passes and as nothing happens, nobody has an incentive to change any of their actions. Is that about right?
So let me be kind of careful here. The nobody has incentive to change is at an instant of time t. As time, that's in the game GT. As time passes, in fact, people will have lots of incentive to change, because as the value of the asset VT updates, you will see that they are going to be, one of the implications of our model will be that they're canceling and resubmitting or repricing their orders. And that will be one of the things that will come out of the model with asymmetric information.
So, so let me make it. So there's already some questions, but now I want to just get that point across. So what you're saying is, it's possible that there. So if suppose everything would be symmetric, the book is symmetric, and so on and so forth, then as time passes and nothing happens, nobody should change any of their behavior, as I understand it.
If nothing happens, you mean no order arrives?
Correct. Then
people don't have any incentive to change anything. You will see that what brings information into the market in our framework is the arrival of orders. Okay, and here orders arrive according to Poisson, and we've got orders, limit orders arrive, market order arrives, both from uninformed and informed. Those will be the things that will cause changes in the limit order book environment.
Yeah.
So now there are. Oh, sorry, Ayan.
Yeah, it's just the order arrivals, as Gideon mentioned, is what is going to change the orders in the book. So that's what is conveying information, as Gideon mentioned. Yeah.
Okay, so then we have a few questions that more or less relate to the pricing grid that you choose. So you have a continuous pricing grid. If you look at papers that Barbara, Sabrina, and Ingrid wrote, they usually have, or also Christine wrote, there's a pricing grid involved there. So do you have any view of how the pricing grid itself affects your the model and your
so first of all, I understand the question. Let me show you how prices are determined in the model. Okay, because the fact that prices are continuous doesn't mean that we don't have very specific prices. We actually find the prices, and that point, if you have questions about prices, we can talk about that. Is that okay?
Yeah, but before you go that way, then that's one very brief question. There's a question about hidden orders in your model, which you don't have. Do you want to quickly comment on that?
Right. I mean, this is not a model with hidden orders, but at least my sense, I spoke about it with Ayan briefly, this type of model, this model that could be extended to introduce hidden orders. As you will see how we solve this stuff, and you will see that there's so many options to extend this model in multiple ways. So hidden orders would be one such extension.
Okay, so let me just see. Duan asked a question of, imagine in your model you would have periodic releases of public information. How would that affect your specific model? And your
basically, what would happen is that this entire range, V plus sigma, V minus sigma, will move around, okay? So as it moves around, of course, orders, limit orders that are not in that range will be canceled and then repriced to be in that range. So that's what will happen. In a sense, when you think about the information environment, think Gloucester Milgram is your heart. This is what we're trying to do.
Okay, very good. I think we can move on, and now you can show us the pricing grid.
All right, so how do we solve them all? I'm going to start by defining wait times. And wait times is exactly what you think they would be. How long an order at a particular position in the execution hierarchy is expected to wait before execution, given a configuration of the book. So here I have kind of an example for us. So you see a book with 4 sell orders, limit sell orders, X1, 2, 3, and 4, and 2 limit buy orders. And so the wait time for the execution of X4, the ask price in the market, is a real valued function that takes the expected value of a random time cap t tilde until the book moves from this configuration at time t to a configuration with just 3 limit sell orders and 2 limit buy orders. Okay, and the notation we use is WT, the wait time of X4, that's the order that's executed, given that the book has 4 orders on the sell side and 2 orders on the buy side. Okay? So this is the definition of wait time. And I'm going to start with a limit order market without asymmetric information. And the reason I'm doing that is because it will simplify a lot of the notation in what we do, and I'll be able to explain to you more clearly the recursive logic. And after I'm done with that, I'll introduce the informed traders. So you may be wondering why waste our time? Because Unit's already proved the equilibrium in his 2009 paper, which is absolutely the case. In fact, he proved the existence of a Markov perfect equilibrium, so we don't have to prove it here. But he characterized the equilibrium in terms of the expected utilities of the traders. And what we're going to do, we're going to provide a completely new characterization of the equilibrium using wait times and limit order prices. And when we do that, that will actually what will allow us to introduce the informed traders into the market. Okay? So once we simplify things, right, without information asymmetry, it simplifies because first of all, for some arrivals, the wait time will not have to have any subscript t, and also without information asymmetry, the other side of the book doesn't affect this side of the book. So we can just say, what is the wait time of the limit sell order x1 when there's only one order in the book? Okay, so wx1x1, that's what we're trying to compute. And this is an example, and 2 things will affect this wait time. First of all, the arrival of market buy orders that will execute immediately our limit sell order. But also, if another limit sell order arrives, it will undercut our order, and then our original order, have to wait until, perhaps wait, we'll talk about repricing, until the time it takes for the second limit order to be executed. So in our framework, the 2 events that will impact the book, right, here's my laser pointer, the next arrival of a trader that will affect the book, either a patient seller, SP, or an impatient buyer, BI, is 1 over lambda BI plus lambda SP, and the probability that this trader is a buyer is lambda BI over that. So now, I know this is kind of a horrific picture, but I'll go over term by term, line by line, so you understand what we're doing here. Okay, so we're trying to figure out what's the wait time of a single limit order in the book when there's just one order. And what we're going to do, we're going to enumerate every possible way that this limit order can execute. So the first thing is, if the next arrival that comes after 1 over lambda BI plus lambda SP is a market buy order, then the limit order will be immediately executed. Okay, so you multiply that arrival by the probability that that will happen, lambda BI, and that's what you're going to get. So this is basically for the case that a market order came and executed a limit. But this did not be the case. It could be that after 1 over lambda BI lambda SP, what the person who will come, the trader who will come, will be a patient seller, in which case he's submitting the limit order, and we're going to have to wait WX2X2, right? The waiting time for the second, the ask to execute when there are 2 orders in the book. And after that, we'll have to wait for another trader to come, and hopefully that will be the buy order, okay? And so this sequence of events will happen with probability lambda SP times lambda BI over lambda BI plus lambda SP. But then there could be another thing, right? It could be that the first limit seller arrived, we had to wait for him to execute, and then another limit seller arrived, and then we had to wait for him to execute, and only then a market buy order arrived. And that amount of time, the probability of that event is lambda SP times lambda SP times lambda BI, okay? And so that way we enumerate every possible way that this our limit order can execute. And when we sum this up, this is the expected wait time. And this arithmetical geometric series fortunately simplified to something very simple, right? Wx1x1 is Wx2x2 plus some terms that depend on the arrival rates. And we can do that for any order in the book. So for example, let's say, we had 2 orders in the book, and I didn't want to know how much to wait for the ask price to execute, but the second one, right? Wx1, x2. Then all I need to do is to remember that basically, if I wait for the ask price to execute, my order will be at the ask price. And so all we need to do is add to each one of those brackets, Wx2, x2. And again, we get a series that we can simplify very much. So every wait time of order in the book can be expressed, right? The Wxn xn can always be expressed as Wxn plus 1, xn plus 1 plus some arrival rates. And that's really the key to what we do. Because now that we've got this recursive thing, all we need to close it. And the way we're going to close it is defined that if a patient trader arrives in the book, after considering the price at which he can execute and the expected wait time, if he prefers to take the outside option rather than submitting a limit order, we call that a full book. All right, so the notation will be WXFXF. How much would that trader that just sits at the full book would wait? We know that the next patient seller who would arrive will simply take the outside options. So their wait time is 0. You plug 0 into a recursive formulation, you get that the wait time of the last limit order when the book is full is just 1 over lambda BI. And that's kind of very intuitive, right? We know that another limit order cell would not arrive to undercut. And so the wait time is simply the expected wait time for a buy market order to arrive. And once we have the wait times, we can now calculate prices. Why can we calculate prices? So the notation we're going to use, we're going to compute price gaps. So the gap between the first and second order, x1, x2, in a book with 2 orders. Let's think about what will happen. Let's do kind of a thought experiment. I'm the trader, limit order trader arrived first to the book. I'm putting my limit order. Then another patient seller arrives. Whenever he puts his limit order, my expected utility, of course, goes down because now, rather than being Wx1, x1, I'm being pushed down the execution hierarchy. I'm Wx1, x2. So what I can do, right, to regain priority and shorten my time is basically lower the price. And if I gain priority at that point, here, I'm going to be Wx2, x2. And so if I do that, what I gain in wait time is Wx1, x2 minus Wx2, x2. But of course, my expected utility will be a little bit lower. Here's the expected utility formulation because I lowered my price. Now, the second trader knows that. So what he will do, he will set in equilibrium the limit order price, his limit order price, low just enough so that if I want to reprice my order to gain priority, I'm losing on the price difference the same much as I'm gaining on expected cost, okay? And that will be the gaps in equilibrium. And that allows us basically to compute the limit order prices with a couple of boundary conditions. The first one will be, of course, the expected value of the asset when the book is full. The other one, we show that in an empty book, limit order seller will always prefer higher to a lower price, so they start at V plus sigma. And then we can compute everything. And when we can compute all the prices, this is the alternative characterization of the Markov perfect equilibrium that Leonid Rosu has in his model. So now that I showed you how to do it in a market without information, let's use that machinery to introduce asymmetric information. So the notion here is going to be that, uninformed traders arrive Poisson random. Informed traders buy according to the value of the assets. depending on their signal. And so their buying and selling kind of change the random arrival of orders, and that convey information to the market. And that's the same spirit of the traditional sequential trade model, except this is way more complicated. So to construct equilibrium, first of all, I'll show you how we characterize the choices of the informed traders. And then once we have that, we'll talk about the Bayesian update of the beliefs that is required for the equilibrium in the G, the infinite horizon game G. All right, informed trader strategies. So in the Glasser-Milgram-Isle-O'Hara framework, there are no strategic consideration. Our informed traders can choose the order direction, order type, order price for the limit orders. So what we show is that when the asset value is low and the sell side of the limit order book is not full, an informed trader mimics the decision of a patient seller. So what's the idea here? Why would it do that? So first of all, an uninformed seller would rather put a limit order if the book is not full because his expected utility is greater when he looks at that versus GT. Of course, if you look at that versus the bid price in the market, it's definitely going to be non-negative expected utility. So the arriving informed trader will, of course, want to submit a limit order rather than a market order. So then the question is, what prices should she choose? And here, what we say is that she will choose the same prices of the uninformed, the patient uninformed traders. Why? Otherwise, let's say she chose another price, then immediately she reveals herself as an informed trader. The value adjusts to V minus sigma. All the traders agree only to trade at V minus sigma, and the informed trader can't make any money. If they submit a limit order, they have a non-negative expected utility. So they will mimic the decision of a patient seller, submit limit order, the same limit order prices. Now, what's happening if the book is full? If the book is full and the sales and arriving informed trader wants to sell, then the informed trader will mimic the impatient seller. And here the idea is that, well, if the informed trader doesn't choose market orders, but rather limit orders, she will have to use a price that the uninformed patient traders are not using, and immediately reveal her presence. Prices adjust, she can't make any money. Of course, with a market order, she can make non-negative expected utility. So what we've seen is kind of in the same spirit of Kyle 85 in our model. Informed traders will choose to buy or sell according to the signals, but with everything else, they will mimic the strategies of the uninformed traders. So now that we know what the strategies are, we can compute the arrival rates. So QT is simply going to be the common knowledge probability time t that the value of the asset is high. And we're going to define lambda TMB, lambda TMS, LB, and LS. These will be the common knowledge expected arrival of market buy, market sell, limit buys, limit sell orders. And I'm going to read only one part of corollary one. At time t, an uninformed trader expects the arrival rate of a limit sell orders, if the sell side of the book is full, to be lambda SP. Why? Because if the book is full, we know that that an informed seller will choose a market order. So the limit orders can only come from the patient uninformed. But if the book is full, then the arrival rate of limit sells will be the orders that are coming from the patient uninformed plus 1 minus Q times lambda I. The orders coming from the informed with the likelihood that in fact the informed saw a low signal. So once we have the arrival rate, then we can compute the same recursive process that I've shown you before to get the wait times. And with the wait times, we can compute the price gaps and the prices, and we've got everything in the GT. Now, I'm saying that it's exactly the same, but there are a couple of differences with informed traders and not. So the first difference is that the wait times will have a subscript T, because of course, QT here is changing all the time, and we need to take that into account. The other thing is that when we have informed traders, the entire book configuration now matters for the wait time analysis on either side of the book. Okay, so, if I know that the buy side of the book is full, I know that the informed traders are using market orders, and that would matter for the execution of limit sell orders. Okay, so this it complicates things a little bit. So we've got a Markov process with 4 states, but again, we can do everything with this recursion to get, W, xn, xn as a function of xn plus 1, and solve this entire thing. So we have got one more step to get the equilibrium, and that's to do the Bayesian learning. So Poisson of order arrivals help us here in a couple of ways. First of all, compound Poisson, simply we do the arrival rate of the patient plus the, informed. Second, the memorylessness property of exponential interarrival times mean that the uninformed traders learn only when the order actually arrives, okay? Because really what brings information into the market in our model is the time between orders when they arrive and that's really how they update their values. So I wrote here an example, but it's just the Bayesian update, right? Tau MB is the time after which a market buy order arrives. And let's say the book side is, the right side of the book is full. We know it can come from a impatient buyer or an informed trader. And so you compute the probability of tau given high and low, the posterior of probability of high given tau, and then the expected value of the asset. And once you have that, you completed the Bayesian process over time, you have the equilibrium in the game G. So this is how we solve the model. What I wanted to do now is go over some of the insights, but before I go into the insights, let's take more questions if there are any questions.
Right, so there were a number of questions that arrived in the meantime, and I brutally answered all of them. So, but I think it probably would be valuable if some of the parts that have been asked actually asked in the open. So I apologize, Ayan, I'm overriding you having answered a question. So the first comes from Yonit. So he says in his 2009 paper, when the book is full, that is, when the, at the ask price, for instance, the trader who sits there has a mixed strategy. It's indifferent between waiting with the limit order at the ask and submitting a sell market order. And randomly at some Poisson time, then cancels the limit order and switches over. So this is something that you don't have, as I understand it. Maybe you want to comment on what the mechanism is at the margin.
Right. So the mechanism that prevents that is really are giving outside options to the patient traders. Remember, they have an outside option at the expected value of the asset VT, and the bid and the ask in the market bracket that expected value. And so our limit order traders will not jump and submit a market order because they can always take the outside option. And because, those are constant arrival rate of Poisson, really nothing changes in the limit order book without information like Unit has in his model. If they found it useful to wait in the book, they will find it useful to wait in the book until an order comes and executes them. And that's what makes, in some sense, one of the things that arise that in a limit order book without information, both ours and Unit's one, it's basically the same. Once a limit order is submitted, in some sense, it would, except for this random thing, because Unit didn't have this VT outside option, it will wait in the book for execution. But that's really not the case. It's when we introduce informed traders, and in a minute I'll talk about those implications.
Okay, so then there's a question here by Jose Pevanella. And it asks, is there a situation when somebody who has submitted a limit order wants to switch to submit a market order? So for instance, if you are an informed trader, that would be an example. If you have submitted a limit order on one side of the book and now somebody else comes in and submits a market order, is there any situation in which you want to switch?
So what will happen is, of course, we just said that the outside option means that the patient uninformed will not switch because they can always take their outside options. The informed trader, when you look at her utility function, as long as it's profitable in its expected utility sense to submit a limit order, she's there trying to profit from liquidity provision. One of the interesting things in a model, in a dynamic limit order book with informed trading, is that if you think about traditional sequential trade models, the informed trader can only profit from her private information. But in our model, the informed trader can profit from both her private information and from liquidity provision. And in fact, we know the way that she will provide liquidity because she will mimic the patient uninformed. So it's kind of the same profitability. And that's something that is very important. It means that, for example, prices in this book are not going to be just conditional expected values given the order flow like in traditional sequential trade model. They will reflect both the expected value of the asset and the compensation needed for liquidity provision, okay, from both of those things.
Okay, so then Yanit has a question about the waiting time and dependent variables in there. So he asked the question of whether or not the wait time, instead of depending on the time, should depend on what the current belief about the fundamental value is, the QT.
It actually does. It does. And it does it in multiple ways. Here, you can see it in some sense on this slide, because it will depend on QT. And QT will enter into it because the arrival rates now are, you know, have QTs in them and so on and so forth. So everything will depend on basically their beliefs about the true value that will go into here, these arrival rates that are used to compute the true value and so on and so forth. Another thing that I haven't showed you, but I just want to be clear, is that our general wait time in the limit order with book with asymmetric information is WT X4 given X4 Y N, whatever, right? Because now there are 4 possible states and the state matter. And of course, the wait time is state dependent and time dependent through the uninformed trader's beliefs.
Okay, so that's another question. So I have a question just for clarification. Now you're saying essentially that an informed trader mimics the behavior of an uninformed trader. But that would mean that whenever any limit order arrives, it contains a portion of information. So does that lead immediately to a change of any orders that are already in the book at that time?
Absolutely. Okay, so if you don't have any other questions, let's move, because this is where we're going. I'm going to talk about that. Yes.
Okay, so let me just see. So Dwayne asked another question about the probability of informed trading. So does your analysis suggest how the PIN, the probability of informed trading in a limit order market, differs from the PIN in a dealer market in terms of how you would derive it?
You know, it's an interesting question. In some sense, a probability, right? I mean, we basically have lambda I, right? And you can think about what are all the order flows that are arriving from the patient uninformed traders, and then lambda I, and figure out what's the probability. The issue with the limit order book model is that while the informed trader will arrive, she may not arrive in the same way, right? Depending on configuration. So in each state of the book, the uninformed traders know whether the informed trader would use a market order or a limit order, but she doesn't know whether they're buying or selling. That's why she's using time between orders to update her beliefs. But basically, the informed traders sometimes can arrive with limit orders, and sometimes can arrive with market orders, and you can use perhaps those probabilities, so those arrival rates, to compute refined probability of informed trade. I haven't thought about it in depth, but those will be then state dependent on the state of the book.
So there's 2 more questions that I want to ask, and then I will be moving on. So the first comes from Michael Goldstein, and he asked, in your model, you have given the recursive feature that you have, can we think that once we know the inside of the bidena of the book, is this a sufficient statistic for the entire order book?
No, not at all. In fact, you will see that the gaps between orders are not the same size. They actually increase as you go deeper into the book, and you need to have the outside prices to compute all the prices. No.
And so then last question that I'm going to admit here is from Albert. He asks, is there a prediction in your model that is idiosyncratic compared to the existing dynamic or limit order models that we have?
Excellent
in the sense
question.
of, can we find a unique footprint of your model in the data?
Absolutely. Let's go to it right now. So the first issue is whether, and that comes to an empirical implication, where the informativeness of arriving market and limit order depends on the size of the prevailing spread. So when the spread is small, right, for book, informed traders demand liquidity. When the spread is large, or larger informed traders supply liquidity. Now, in principle, that may not seem surprised to you. We know that for uninformed traders in the dynamic limit order book. But remember, these are informed traders. This is very different from what informed traders do in a dealer market. And we know why it arises in our model, because we can solve it. We know that it's because of their hiding strategy. So when testing this prediction empirically, right, I mean, you can't figure out when the book is full or not necessarily, but it's always possible to define two categories of spread size based on historical distribution. And then limit orders should carry more information when the spread is large, and market orders should carry more information when the spread is small. And to the best of my knowledge, this is a new implication, doesn't exist in other models. Last night I read an email that Tally sent me because he saw the abstract of this talk, and he said, you know, I have a working paper that actually finds these results. I haven't read the paper yet, but this will be a new empirical implication. So that's one. Another empirical implication, new empirical implication, has to do with the way uninformed traders learned about information, right? They learn from the time between order arrival. So any difference between the expected frequency and actual frequency of orders that could come from informed traders would lead to a price impact, price revisions. And so, you know, I've estimated duration models in empirical work. You can always estimate it, what's the expected arrival rate, and then look for the limit or market orders that arrive faster than expected and slower than expected, and those arrive faster should have a larger price impact. In fact, you can also do it by spread is large, spread is small, and our model will give you very crisp predictions on when you should find a higher or lower price impact. And in fact, we can show, and we show that the magnitude of those price impacts or price revisions increases with the volatility, the fundamental volatility of the asset. Another insight that come out of the model is this issue of repricing, which was your question, Andreas. Right, every order that arrives that could come from informed trader, depending on the state of the book, a limit order or market order, immediately causes a repricing of all the limit orders in the book, right? This is kind of in the dynamic game, in the infinite horizon game G. They can cancel and resubmit as we move from GT to GT to GT, depending on the orders that arrive. So first of all, you know, kind of what, and that doesn't arise at all in a model without informed traders. So this very frequent cancellation and resubmission, and the fact that the gaps are constantly changing could be viewed, perhaps somebody could develop from that an empirical measure of informed trading. But beyond, I mean, this is not necessarily something I would test. I would say that people like myself, and I have worked with Joel Hasbrook, we've seen a lot of fleeting orders. We actually try to trace those resubmission, right? Our strategic run in our low latency trading. We know this happens in the market, and there's almost no model that can actually generate that implication, and our model does that. So, you know, some people say that those frequent cancellation and resubmission are kind of evidence of nefarious HFT strategies that are harmful to the market, and we need to inhibit them. Not everybody agrees. So Shmuel and Larry have this paper where they've got liquidity suppliers game, and they have mixed strategy equilibrium, and they interpret the mixed strategy as cancellation and resubmission when the liquidity suppliers are kind of protect themselves from being undercut. We provide another rationale for the frequent cancellation and resubmission of limit orders. It's the equilibrium response of limit order traders to the presence of the informed traders. And if we think about it as the equilibrium response of uninformed traders, then having regulation that inhibits that may not be beneficial to markets. The last thing I wanted to note, it's kind of a thinking point, you know, in terms of the model, has to do with this whole notion of regret-free prices that we're so accustomed to from the Glosser-Milgram-Izzi-O'Hara models. So our model can accommodate various conventions with respect to the order of events. So convention one could be, as an order arrives, the limit order traders see that, update their orders, and then the order execute. And that gives you regret-free prices. And it kind of reminds you a little bit of Vincent van Kervel book about, paper about HFTs. But some people may not like that. They'd say, well, we've got in the US auto execution in financial markets, the orders should execute it. Only then people should be able to condition. And if you want to have that, that's fine. Our model can accommodate that at all. You're not going to have regret-free prices. But the regret-free prices in the Glosser-Milgram-Izzi-O'Hara model is not by, first of all, seeing the order, updating, and then executing. The way they do that is they condition already their ask price, say, on their next arrival of the market buyer. So let's call that ex-ante regret-free prices. And then the question is whether ex-ante regret-free prices are even feasible in a limit order book. And you need to answer a few questions. First of all, what orders would you condition on? Market orders or just also limit orders? We know limit orders convey information. Second, which prices should reflect this? Just the top bid and ask prices or all limit order in the book? We know all limit orders are repriced when information arrives. And even if you say, well, I'm going to choose to have just the bid and ask prices, just as the information content of market orders so that the executions would be regret-free, then I can tell you that this is impossible with Poisson arrival of traders, because with Poisson arrival, which is used in so many models, one cannot learn from the passage of time until the order actually arrives. So ex-ante regret-free prices are impossible in a limit order book with Poisson arrival. But it's a model that gives us a way to think about it and say, well, if you want those ex-ante regret-free prices, you need to have a different arrival process, which is not memory-less. You need to think very careful about prices, which prices change. And that's kind of some of the insights that we get from this model. So we've got a few more implications, but I'm kind of running out of time. So conclusions. You take a Gauss-Amigo-Mizzi-O'Hara, you swap the dealer model with the limit order book. What do you get? Certain things are the same. Order flow brings information to the market. Uninformed traders incur execution costs when they submit market orders. But a lot of things are different, right? We talked about the fact that the transaction prices are not conditional expected value, right? They contain that in a compensation for liquidity provision. Uninformed trader uses market and limit orders depending on the prevailing spread. Prices, you see cancellation and resubmission constantly as traders learn from the time between order arrival and change the limit order. So a lot of things we got, at least Ayan and I got a whole bunch of new insight, and I hope that we got something else. We got a limit order book under asymmetric information that we could solve analytically and hopefully can be used by other people and us to tackle a whole bunch of interesting questions in what is today the most common market structure. So I think I'll end here, thank you, and I can take more questions.
Well, thank you, Gideon. This was great. So we now have enabled the raise hand feature. So if you raise your hand, we will let you ask a question in person. Just as a quick note, we have another 8 minutes in the official part, but Gideon has agreed to stay on for a little longer for those who are interested. So are there any open questions? Yonit, you have typed a question. Maybe you want to raise your hand so that I can enable you to speak. There he is. Oh, okay. So, Björn, I cannot make him unmute Yonit. Can you do that? Yonit, can you unmute yourself? Oh, there you go.
Yeah, hi Gideon, how are you? Yeah, sorry, I have my kids watching cartoons next to me. I hope it's not too loud. I was actually, I did not fully understand your answer to Michael Goldstein. So I had another question before, which is you said whether there's a way for the inside bid-ask spread to fully summarize the state of the book. Because in fact, it may be possible. I think your state variables are the number of buyers, the number of sellers, and the probability of the high state, that these are the state variables that describe your limit order book in the end. So isn't it possible in principle that since this is a continuous price grid, isn't it possible that you actually can have a unique bid-ask spread for each state of set of states?
So I'll give you an example, and Ayan can jump in also with it. So if that were the case, one implication probably would have been that we could just find the inside spread and follow that. And the answer to that's impossible, because when the book is full, the only pricing implication we get is an inequality, not an equality. What we get is the gaps going. We can basically at each point in time calculate all the possible gaps. Then the equality conditions we have is the outside. And then we have to rebuild all possible prices that will prevail. And then we know what is the price for the full book. Okay? Yeah. Each time, that's the process we need to follow. And so it's not clear to me that if you just knew the inside, you could. Ayan, what do you think?
Yeah, if I may just chip in a bit here. So I think what Leonid, you're asking is whether those pieces of information are enough to calculate all the prices. So the answer to that question is yes. But what Gideon is saying is also that once you get those prices, it's not that all the price gaps are the same, but Michael's question, as well as Leonid, both of you, what you're asking is what's just the minimum number of variables I require to calculate all the prices. For that, all you require is really V plus sigma, V minus sigma, the outer boundaries, the lower boundaries, and the arrival rates, as you said, Leonid. So that I think is the way to one way to think about that question.
Right. Because what we're tracking is just QT and XT and YT. Right?
Yeah.
Yeah.
Okay, very nice. Can I ask another question? Because yeah, so does the public eventually learn V? Does it converge? So sort of QT to 1 or 0, depending on the true V or something like that, as in Gloucester and Milgram?
Yes, there is a convergence and as time goes to infinity. That's a very interesting issue, whether how trading looked like towards the convergence. And because, remember, in this book, price is not conditional expected value because you require also compensation for liquidity provision. When price is adjusted enough that are very close to either V plus sigma, V minus sigma, one side of the book will actually shut down. But convergence will continue because one side of the book will continue to be active. On one side of the book, it's simply not going to be profitable to supply liquidity anymore. So remember, this is the limit of the book. If it's not profitable to supply liquidity, nobody would supply liquidity. But convergence continues as order arrive. Yeah.
Yeah, I think your model is very nice because it's the simplest possible framework with a constant fundamental value and two possible values, a binomial distribution. So the previous models were a bit more complex with V moving around, and that's why you couldn't solve them. So the fact that you can solve them is very nice. That's
Thank
great.
you. Thank you.
Yeah, it seems the outside option is also very useful in this one.
Yes.
So I currently have nobody else raising their hand. Is there any other one else who wants to ask a question? Mike Roy.
Hi. I guess because no one else asked a question, I'll ask this sort of very broad question. So for this paper, towards employing it as a workhorse for new limit order book applications, what sort of intuition do you have in terms of the framework's ability to handle, for example, I'll think of things close to my heart, access fees, or a problem that might necessitate fragmentation? That last one I think is really hard, but things like that. Do you think you could drop that in this model and kind of get some comparative statics out of that?
So I'll give you my hunch because we haven't done it.
Sure.
But the way, it's interesting. So think about how this works in papers that try to do that in a sequential trade model framework, traditional one. What they did is they had, let's say they split their arrivals. Informed traders go here, they go there, and so on and so forth. The same type of thing would happen here. You could take the Poisson arrivals and you can split them, and you can, and really all the action in this model come from the arrival rates, right? And I think therefore that you could incorporate a whole bunch of permutations of where arrival rates, what affects arrival rates, and then it will percolate into the model and will give you implications. So that will be kind of my intuition, but we haven't looked at those.
Sure. Oh, great. Thanks. That definitely answers my question. Thank you.
So I see that there is no raised hand at this moment. We are at the end of the official part, but Gideon has agreed to stay a little longer. So if anybody has other questions, then we can still admit them. I want to thank Gideon again for this presentation. It was very insightful. Among many other things, we learned that dynamic limit order markets with asymmetric information are hard. And so it's useful to have a model that we can actually use. So that's great. And just again, to reiterate my announcements from the very beginning, next week we're very happy to have Justice Bat give us a presentation. We will soon open a call for the fall presentations, which will be generally open with the submission deadline of June 30th. And again, I want to thank all the reviewers for who helped us with the decisions for the Emerging Scholars Month in July. And also, of course, thank the submitters for sending us their papers. We will make the announcement about the papers that have been selected within the next few days. So again, thank you, Gideon. The official part is now concluded, and Gideon stays on for a little longer. If somebody wants to raise their hand, please go ahead.
I see that Joel raised his hand.
Yeah, Joel, go ahead.
Hi, Gideon. Can you hear me?
Absolutely.
Good. All right. This question is actually one of the things that struck me about this equilibrium is that the informed traders exactly mimic the uninformed, and it seems to me that this would also make the market kind of stable against manipulation, in that if you had somebody who came in and tried to pretend that they were informed, you would know that they were not behaving as a true informed trader, right?
It sounds like almost an out of equilibrium question, because somebody who has something to lose, which is somebody with real information, will never do that. It takes the assumptions that we made, and you can clearly see what the assumptions are. You know, that prices will adjust immediately if the information is revealed, right? So whenever you've got anything that will give you an advantage, if prices are not revealed, you are not going to choose to reveal yourself as an informed. And so somebody else who does something like that, which will be, of course, an off equilibrium thing, you know, shouldn't be gaining anything. But again, that's a completely off equilibrium thing.
Yes, that's true.
But an informed trader would have no incentive in our framework. Anybody who could gain from the prices not yet adjusting to do something like that.
Yeah, if I may add just, Ayan here, if I may just add one sentence here. So another way to think about this is just like in the Kyle model, the informed traders really, even there, they are mimicking the uninformed traders. So that is a useful, intuitive way to think about even what's happening in our model. We have more types of uninformed traders, but in the end, informed traders want to hide behind the uninformed traders as much as possible. Yeah.
So Amy is next.
Hi, Gideon. I enjoyed the paper.
Thank you.
I had a question about the implications of your model for how we estimate the costs of limit order submission.
When you say that the cost of limit order submission, what is it?
So I think I'm not referring to the opportunity cost of limit order. Well, I guess we are, but when we measure transaction costs, I think for market orders, you know, we've pretty well centered around effective spreads. For limit orders, you have the execution rate, you've got the implementation shortfall, though implementation shortfall has issues in how you calculate it. At least when I was seeing this, it was almost as if you could really rely on execution rate or time to execution for the limit order transaction cost. And I wanted to see if that was your thinking as well.
It's an interesting question, and I must admit I haven't thought about it. One thing that, if you think, you know, limit order provision is profitable in our framework, right? The uninformed patient traders doing it because it's profitable for them from an expected utility, which means, first of all, whenever you see limit order provision, it means that this is a no expected loss situation. The same way that you would perhaps compute from like a mid-quote, you know, an execution cost for a market order, that will be the execution gain exposed, right, for a limit order trader. And you can get a sense of maybe over time how much compensation they require for providing liquidity. Ayan, do you have some other intuitions here?
But I guess with the repricing, where the order is relative to the original mid may change.
Right, and so one of the interesting things is what causes repricing. So repricing in our model is strictly the information-based repricing, and they are repositioning themselves to basically always get compensated for liquidity provision based on their best estimate of where the true value is. Okay, so when they reprice to a limit order price that again would give them compensation for liquidity provision. So you're right that the that's a very, very nice question, because now I'm starting to think about what you're asking. So really the relevant one of the relevant things would be that really their ex post compensation is the distance from the, say, mid-quote or whatever, when the order executes, not when the order was submitted, because all the intermediate steps, right, had to do with the information update. And then you can perhaps use that to split your estimate of the compensation into something that is due to their loss due to having information asymmetry, as opposed to their gain from liquidity provision. Those should be kind of different construct, and that may be a way to do that using, the mid-quote when they was submitted, the mid-quote where they executed, and the actual execution price. Does it make any sense to you?
Yes, I think so. I think that's an interesting way of looking at it.
Okay, I'm gonna, next is Cameron.
Oh, hello, can you guys hear me?
Absolutely.
I see my face, so I can be heard. Okay, so it seems like a lot of the analytical work in here is actually deriving waiting times conditional on arrival rates. So do you have a sense of how complicated it would be if you wanted to condition some of the arrival rates, or do some kind of endogenous arrival rate, if you wanted to model an HFT or something? It seems like that would make it very complex and, I don't know, maybe intractable. I don't know if you have a good sense about.
So the question is, what would your trader, what would you want to condition it on? So in our model, the informed traders' arrival rate are conditioned on what they observe as information, and not just, well, it's not their arrival rate. Their choice how to trade is conditional on that, and that changes their arrival rates, right? The arrival rates, when you introduce information, the limit buy order, say if the buy side is not full, it's not going to be just lambda BP, it's going to be lambda BP plus QT times lambda I, right? And so if you structure it in this way, you could easily incorporate that in our framework. At least that's kind of my initial thing. I'm not sure about other things. I haven't thought about that.
Okay, cool. Thank you.
So I saw someone else raising their hand, but I want to quickly ask a question. So I want to go back to the question that you had earlier about the probability of informed trading, which is something that we, which is one of the really nice insights for me, I think, of asymmetric information trading. So one of the most fundamental things that comes from your model is that informed traders also submit limit orders. Yeah. And so but they do submit it differently depending on whether or not the book is full or not. So would it be fair to say that there is a way to measure, so if we want to measure informed trading, instead of using what we do based on Gloucester-Milgrom is just the imbalance of buy and sell orders, so the marketable orders, what we'd have to do here is we'd have to count marketable orders, or the imbalance of marketable orders, and then also the imbalance of limit order submissions conditional on the state of the book. So for instance, where if you want, I know you don't have tick sizes, you have a grid, but in normal markets there is a grid. So where people submit relative to the other side of the book, would that be fair to say?
So I think that what you're raising, I'm separating the issue of pin from the issue of the grid for a second. Yeah. Absolutely. So let's say that you would empirically estimate two, based on historical distribution for this asset, two categories of spread size that will proxy for the full book or not full book. And in each one of them, you will compute PIN differently. In one of them, PIN will be based on the marketable order. And on the other one, PIN will be based on the limit orders. Okay? And not on executions necessarily at all, just of the arrival of the limit orders. And I think that could be neat because maybe, you know, estimating PIN these days is tricky. It's tricky because the usual way that we used to estimate PIN with the maximum likelihood, there's so much trading in the exponents that is, you know, I'm not sure we can do it this way. Now, I'm not necessarily sure that our model solves it as well, that particular problem, but having both market and limit orders, one could possibly devise a way to do that, at least under certain assumption. Let's say I assume that the lambdas are the same for the patient traders, which you would assume in kind of a stable book, right? Then perhaps you could think about the ratios and estimate it this way. So I think it opens, and again, I haven't spent time thinking about it, but it opens a lot of possibilities.
Very nice. Shaoyun, I just allowed you to talk.
Yep, thank you. First of all, I wanted to say that this is a beautiful, beautiful model. Thank you. I really enjoyed it. So my question is, the informed traders, they would want to mimic the patient as the uninformed traders. Now, is there a possibility that the uninformed traders would want to submit their limit orders in a way to make the informed ones not want to mimic? And maybe they would just like be strictly better off by separating. Is that a possible deviation for the uninformed traders to submit their limit orders? Thank you.
Not one that we've found. So we found that, you know, and they are taking into account the strategies of the informed traders, right? Because their strategies are based on their arrival rates. And now their arrival rates do include those of the informed traders. So everything is internally consistent. We haven't, I think, found any deviations that will be better for them. Ayan, do you have any idea?
Yeah, I'll just bring in the intuition of Kyle here again. So again, it's just like in the Kyle model, the uninformed would not want to change. So that's kind of the same thing that's happening in our model. Plus, there is also a certain amount of exogeneity in the uninformed behavior. So you, just like in Kyle models, there is a noise trader. So in our setup, there are these impatient traders whose behaviors to some extent is exogenously determined. So it's a combination of factors that prevents these traders or makes it unattractive to these uninformed traders to change their behavior. But an easy intuition is just like what happens in Kyle model, but with many more types of orders and traders.
Right. Although I must say that I will be, and I've used the analogy with Kyle, so I'm, you know, just as a shorthand for being strategic trader for the informed, but I would be a little bit cautious just with that analogy, because while the impatient uninformed traders are exogenous, like in Kyle, Ross, and Milgram, the patient informed traders do have a strategic short, right? They choose their prices in some sense. And so that's why it's not exactly like in Kyle where everything is specified exogenously. But, you know, as we thought about it, and we look at the decision of the informed trader. They have a utility function, but it's not very complex. We couldn't find, once we incorporate the informed traders and the uninformed take that into account, we did not encounter any profitable deviation.
So Dwayne asked a question in the chat, in the Q&A. I wonder if you want to ask it in public.
Okay, sure. Thanks, Gideon. Enjoyed the presentation a lot. So this is going back to the discussion about manipulation, and was just pointing out that the way things would work is that if the informed investor submitted an order that an uninformed investor would not submit, then the conjecture was that there would be an inference that it is either unambiguously good news or bad news. So if I had good news, I would try to manipulate the prices by first selling, and then the critical assumption is that once a trader's order is executed, they have to leave. But if they could stick around, then there'd be an opportunity to manipulate.
Right. So now I understand. You're absolutely correct. So remember, we chose to extend, right? If we think about the two canonical frameworks from the 80s, the Asymmetric O'Hara or the Car, we chose to extend the one with many informed traders. Each one of them, arrives once and so on, as opposed to the single informed that goes back into the market. And you're right, in that framework, that what would make it the manipulation not an issue. And I should have known that answer immediately. So I appreciate it that you brought it up.
But this makes sense. You're trying to find, the goal here was to find a minimal model that will allow us to have an analytic analysis of a dynamic limit order market. And so, manipulate, you can't have everything. So the manipulation thing may be a reasonable thing to give up.
Thanks.
All right. I think we've taken enough of your time, Gideon. I really appreciate you sticking around for some more time. I want to thank every one of the attendees and all those who asked questions for attending our webinar.
And I wanted to thank, first of all, everybody for all the questions and attention. And again, you guys for organizing it. I think it's a wonderful service to the market microstructure profession to have such a seminar series in this period. So thank you so much.
Our pleasure. Okay, goodbye, everybody.
Bye.
Thank you.